As much as we avoid talking about our losses, stock market YouTubers are not immune to bear markets. And personally, I've lost over $7,000 putting a good chunk of my net worth into a small cap speculative SPAC play. So today, I'm going to be turning this into a lesson on how you can recover some of your biggest losers. Now, there's a few different ways that we can do this. I'm going to start out with the easiest way to make our money back first and then work our way up to more advanced strategies by using options trading. And the first way to make your money back is just going to be to buy more shares in the stock, but that's if you still believe in the company. Now, if you don't believe in the company anymore, then it's just time to cut your losses and move on, because pretty much every stock is at a discount right now, which is the perfect opportunity to be concentrating into the stocks that you're most bullish on. This is what I've been doing over the past few months since we've been in this bear market. I've been selling out of Apple and Square just to pile into Tesla and AMD because I think that Tesla and AMD have better potential. So I've been concentrating in buying into these stocks and selling out of the stocks that I'm less bullish on. And the way that I've been doing this is just by dollar cost averaging. So, for example, I have $1,000 a month that I can spend on stocks every single month. So I could invest that $1,000 every single paycheck that I get at the end of the month, or I could split that up into 4 and buy $250 worth of stock every single week. And if I were to do this on the stock that I'm down the most on, my average cost for buying into the 1,000 shares that I own right now is above $12. And now the stock is trading at $5.70, which means that I'd be getting it at a really good discount and bringing down my average cost for every share that I buy at the lower prices. So as I'm bringing down my average cost, it's going to make it easier to make my money back once this bear market is over. But this is just plain simple investing, buying and holding until you're profitable. If you want to make your money back a little bit quicker, then you could try trading options like selling puts. And whenever you sell a put option, you're agreeing to buy 100 shares of your stock at the strike price that you choose. And you're going to need enough cash to buy 100 shares of the stock at that strike price. This is what's known as your collateral. So for example, the stock that I'm invested in is trading at $5.70. And if I decided to sell the $5 put option, I'd be agreeing to buy another 100 shares of the stock at my $5 strike price. I would need $500 in cash as collateral to put on this trade, but the person that's buying this put from me is going to pay me $15 in credit. This means if my stock is below my $5 strike price on my expiration date, then I have to buy 100 shares of a stock at my $5 strike price, but I still get to keep the $15 in credit, which is going to bring down my effective buying price to $4.85. This is what's known as our break even. So anything below $4.85 after our expiration date, then I would be at a loss for buying those 100 shares. But anything above $4.85, I would be at a profit. And finally, if the stock is above my $5 strike price on my expiration date, then I don't have to buy the 100 shares. I get to keep the $500 in cash, and I still get to keep the $15 in credit. So if I decided that I wanted to double down on this position and buy another 1,000 shares, I would sell 10 put options at the $5 strike price. I'd be collecting a total of $150 in credit, and I'd be agreeing to buy 1,000 shares of the stock at my $5 strike price. This means if the stock ends up below my $5 strike price, I'd be effectively buying 1,000 shares at $4.85, and right now my average cost is above $12. So this would bring down my average cost to around $8.79. It's going to be easier for the stock to recover to $8.79 than it would be for the stock to recover to $12. So I'd be able to make my money back a little bit quicker using this way. But this is a really costly method in order to make your money back because, again, you need enough money to buy 100 shares of a stock at the strike price that you choose. But if you already own 100 shares of the stock, then you could sell a covered call, and instead of using cash as collateral, you're going to use your 100 shares as collateral instead. And whenever you sell a covered call, you're agreeing to sell 100 shares of your stock at the strike price that you choose. So for example, if I decided to sell the 750 call for the stock that I own, then I'd be agreeing to sell 100 shares of my stock at 750, and the person that's buying this call option from me is going to pay me $13 in credit. This means if the stock is above my 750 strike price on my expiration date, then I'm going to have to sell my 100 shares at the 750 strike price, but I still get to keep the $13 in credit. So effectively, I'd be selling the shares at $7.63. Again, this is my break even. So if it's above $7.63, then I could have sold the shares at a higher price. But if it's below $7.63 after my expiration date, then I would actually end up at a profit. And finally, if the stock is below my $7.50 strike price on my expiration date, then I get to keep my 100 shares and I get to keep the $13 in credit. So if I decided to put up all of my shares as collateral, my 1,000 shares, I could sell 10 of these options and collect a total of $130 in credit. And we can think of this as bringing down our cost basis for owning these shares. So each time that I sell 10 of these call options at $13, I'd be effectively bringing down my cost basis by 13 cents, which isn't a lot, but it's still around 1% each time that I sell one of these calls. A quicker way that you could probably make your money back is by using what's known as STRANGLE, to where you're selling both a put option and selling a call option. So whenever you do this, you're agreeing to buy 100 shares of your stock at the put strike price, and you're agreeing to sell 100 shares of your stock at the call strike price. So if I decided to combine the both of these examples, I'd be agreeing to either buy 100 shares at my $5 strike price or sell 100 shares at my $7.50 strike price. And in total, I would get $28 in credit. This means if the stock is below my $5 put strike price on my expiration date, I'm going to need to buy 100 shares of the stock at $5. But since we collected $28 in credit, our effective buying price is actually going to be $4.72. And if the stock is above $5, I don't have to buy another 100 shares. But if the stock is above $7.50, then I'm going to have to sell 100 shares of the stock at my $7.50 strike price. But since we're getting $28 in credit, my effective selling price would actually be $7.78. And if the stock ends up between my strike prices of $5 and $7.50 on my expiration date, then I don't have to buy 100 shares. I don't have to sell my 100 shares. Instead, I get to keep my 500 in cash and my 100 shares, and I get to keep the $28 in credit. So again, if I decided to sell 10 of these and either double down and buy another 1,000 shares or sell my 1,000 shares, I get a total of $280 in credit. So this strategy is going to work a little bit quicker in paying off your losses. And finally, the last option strategy is what's known as a strangle, where you're selling both a call option and a put option at the exact same strike price. So for example, if I sold a $5 put and a $5 call on my stock, I'd be agreeing to either buy 100 shares of my stock at $5 or sell 100 shares of my stock at $5. And whenever I sell the strangle, I'm going to get paid $108 in credit. So my effective buying price if I had to buy 100 shares of the stock at $5 will be $3.92, but if I had to sell my 100 shares at my $5 strike price, my effective selling price would be $6.08. Now, $6.08 is a far cry from my average cost of over $12. So this wouldn't be an ideal strategy for a stock that you want to keep. This would be a better strategy for a stock that you want to let go of and concentrate into other companies. But that's all the strategies that I've got for you today on how to make your money back. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.